Well, for more on the impact of the Fed's rate cut on the US economy and global markets, I want to bring in Jameel Ahmad, Chief Analyst at GTC. Thanks so much for making time to speak to the program. Now, the Fed has indicated it will cut interest rates by another 50 basis points this year, with an additional cut expected in 2026 and 2027. Now, markets had anticipated a more aggressive schedule, forecasting 3 cuts next year. But is there still enough room for the Federal Reserve to reduce rates without further risking higher inflation?
Thank you, Vivian. And I would say that, yes, there is enough movement on the Fed to move interest rates lower over the upcoming period. But to use a bit of a metaphor here, it's time to bite the bullet now, because if you look at inflation, the CPI on an annualized level over 2025 so far, it's ranged from 2.9 to 2.4%. The issue at hand is that as the summer period has started to, I would say, conclude, we're starting to see inflation go back towards 2.9%. And now that we have clarity on what the tariffs will be, where the US administration have put in tariffs on numerous different world economies, this is seen as increasing the risk of inflation going up over the coming months. But if you look at the interest rate of the Federal Reserve, it now stands between 4% and 4.25%. So if inflation hypothetically moves back above 3% between now and the end of 2025 and potentially stays there, there is some movement. But to avoid I would say a metaphor being stuck in the mud or fears of the US central bank moving too late, it's better to use these interest rate cuts that the market wants and is expecting sooner rather than later. And actually, I thought that the Fed would move by maybe 50 basis points over the coming period, so that the Fed are not under pressure to move consecutively. But if they move by 50 basis points, which means 0.5%, then the market can cool down its expectations for 2026 and beyond.
What about the effect on global capital markets then, given this 25 basis point cut, and particularly the effect on stock and bond markets?
Well, if you look at world stock markets over the past couple of weeks, we've already seen multiple all-time highs, specifically with the US financial markets, but we should also applaud the increase in sentiment towards emerging markets too. And we know historically that lower interest rate expectations in the United States does suggest increased sentiment for emerging markets. We're starting to see that trend. But where I would pay attention particularly is on the dollar index, which has now dropped to its lowest level in more than 2 years. And actually, if you look at what's happened since the Trump administration returned to the White House, you had the dollar index above 110, and now it's moved back towards 96, 97. Those are the sharpest drops we've seen since roughly the global financial crisis. And I do think that more we see weakness in the US economy when it comes to jobs data, the more that we see pressure on the US Federal Reserve to cut interest rates more aggressively, which they are being pushed for. I think that more weakness for the US dollar is likely ahead. And that is also supported to gold, which we should mention hit a new all-time high of around $3,700 since the Federal Reserve interest rate meeting started.
You just mentioned jobs data. Which economic indicators will the Fed be closely monitoring ahead of its upcoming meetings this year?
Well, actually, I'm going to repeat myself here, is the jobs data, because if you look at the trend that started to form over the past couple of months, we are seeing weakness in the US jobs market. Why is this important? Firstly, if you look at US consumer spending and the GDP components, consumer spending does account for the largest component of the US economy. So far, softness in the US jobs market is not suggesting lower retail sales and consumer spending. Nonetheless, you just had a downward revision between the period of March 2024 to March 2025 of close to 1 million jobs. That was overestimated for the US economy. You had only 20,000 jobs added to the US economy last month, and a weak number the month before. So I think the Fed are going to start to be a little bit pressured by softness in the labor market, which is the jobs market, that then suggests that the Fed will need to start cutting interest rates more aggressively to ease tensions. Having said that, we will still watch the inflation numbers, but I would say the real number that we're going to catch our eye right now is the jobs data.
And beyond that, Fed Chair Jerome Powell did describe the recent rate cut as risk management. Of course, we've just talked about the jobs data. Are there any other risks facing the US economy? I mean, inflation comes to mind.
We're seeing some softness when it comes to the world economic data, and we've seen US GDP kind of moderate and be a little bit softer in 2025. But we have to be fair to the US economy here that since 2022, it has completely outperformed all of its global peers, the types of numbers that would catch the envy of Europe, the United Kingdom economy, and so forth. So we do expect to see some slowing down with US economic momentum for 2025. What we're going to watch out for now, though, moving forward, is whether industries and sectors are impacted truly by what are finalized numbers when it comes to the trade tariffs. And I think that's what's impacted the Fed mostly for 2025. There's been so much uncertainty when it comes to tariffs. Of course, those tariffs impacts businesses' certainty too. But now we actually have a line in the sand towards some end of the tunnel when it comes to the tariffs. And I think that's what we're going to be watching out for now. US economic data, including inflation as well, PMI, services sectors, and so forth.
All right, we'll leave that there for now. Thank you so much. That was Jameel Ahmad, Chief Analyst at GTC, joining us from Dubai.